It's an even bigger crash than 2008. In this city, home prices are already down over 25% and rents are collapsing as well.
And then one day, no house, no trailer, just flattened, like there'd been a miniature atomic bomb that went off.
Everyone remembers when moving to Texas seemed like the smartest decision in America. Cheap homes, low costs, endless growth. But across parts of Texas today, entire neighborhoods of brand new houses are struggling to find buyers. Some streets remain eerily empty. Builders are slashing prices. And in certain suburbs, the dream that attracted thousands of newcomers is beginning to crack. In the 10th place, Plano is experiencing a quiet shift that is catching local homeowners off guard. Plano became the ultimate symbol of the Texas suburban boom, a prestige market fueled by top-rated schools, corporate headquarters, and absolute buyer confidence. But today, the momentum has stalled. In March 2025, the median home price in Plano stood at $550,000. By March 2026, that median fell to $490,000. That represents a 5% drop, though some real estate indexes point to a year-over-year decline closer to 10%. Properties that once sold in days now linger for weeks. Buyers who once rushed into bidding wars are stepping back, forcing sellers to offer repeated price cuts to close a deal. While local residents are not panicking, many are adopting a cautious, wait-and-see approach. This cooling trend in an established powerhouse suggests that even the safest suburban bets are adjusting to a new economic reality. Number 9. Katy, a massive suburb west of Houston, was once the ultimate poster child for unstoppable suburban expansion. Developers poured concrete across thousands of acres, launching master-planned communities that promised cheap land and endless growth. But today, that massive engine of new construction has collided head-on with a wall of buyer hesitation. In the broader Houston area, inventory has surged 7%, and homes are now languishing on the market for an average of 50 days, a 16% increase in selling time. To keep these brand-new streets from sitting completely empty, builders are resorting to aggressive tactics. They are slashing prices and offering heavy incentives, from $10,000 closing cost credits to permanent mortgage rate buy-downs. While some blame local reputation, the real driver is a direct oversupply of homes colliding with high interest rates. Even though Katy sits in Harris County, where the property tax rate is a remarkably low 0.38%, that tax advantage cannot rescue buyers from severe payment shock when mortgage rates hover near 6%. Katy stands as a clear warning. Before property taxes even enter the equation, pure housing oversupply can halt a boom in its tracks. 8th place. Leander, a fast-growing suburb north of Austin, is facing a severe wave of affordability stress. During the peak of the migration boom, families rushed here expecting cheap land and easy appreciation. But today, that dream has collided with harsh financial realities. Active listings in the Austin metro area have climbed 5.3%, and new listings have surged 7.2%, driving inventory to a substantial 5-month supply. While other suburbs on our list struggle with pure oversupply, the central challenge in Leander is buyer qualification. In Williamson and Travis counties, high property taxes combined with elevated mortgage rates have turned homeownership into a major monthly budget struggle. Young families and move-up buyers who once easily qualified for loans now find themselves priced out of these master-planned neighborhoods entirely. Even though local population statistics still show growth on paper, actual buyers cannot comfortably clear the high bar of qualifying for a mortgage. Leander has become a prime example of a suburban market where demand remains steady on the surface, but high carrying costs have made new homes financially inaccessible for normal working households. Number 7. Frisco represents what happens when a highly polished North Texas success story suddenly loses its automatic urgency. For years, this community served as the ultimate magnet for corporate relocations, out-of-state families, and massive residential investments. During the height of the relocation boom, buyers flooded into master-planned subdivisions, outbidding each other by tens of thousands of dollars just to secure a piece of the suburban dream. But today, the local housing engine is experiencing unmistakable pricing fatigue. In the broader Dallas-Fort Worth metroplex, overall inventory rose 3.4% in March 2026. Even with new listings dropping 8.3% in April 2026, the homes already on the market are lingering far longer. This cooling trend strips away the resale advantage that local homeowners once took for granted. Families who bought during the peak expecting quick appreciation and effortless exits are now confronting quiet open houses and forced price cuts just to sell. Rather than a catastrophic collapse, Frisco is undergoing a sharp recalibration of expectations, where buyers hold the cards and sellers must wait out the market. This shift marks a transition from suburbs suffering from quiet financial softening to communities where the slowdown is physical, with empty streets and brand new developments sitting silent. Number 6. Celina has become the epicenter of a highly visible suburban disconnect, where the aggressive sales pitch of a future metropolis meets a sparsely populated reality. Located on the far northern edge of the Dallas-Fort Worth metroplex, this community transitioned from quiet farmland into the poster child for hyper-expansion, driven by projections of endless population inflow. But the physical footprint of this expansion has outpaced actual buyer absorption. Throughout Celina's massive master plan developments, the ratio of unsold lots has climbed significantly, reflecting a broader Sunbelt trend where the new construction pipeline is running far ahead of immediate demand. Walking or driving through these brand new neighborhoods reveals an eerie silence. Rows of pristine, completed homes sit empty, streets are completely clear of parked cars, and planned subsequent phases remain as graded dirt fields with no active crews. To combat this sudden freeze, major homebuilders are aggressively slashing prices and offering heavy financial promotions, including permanent mortgage rate buydowns and thousands of dollars in closing cost concessions. These master-planned communities are designed to look like thriving, dense suburban havens, yet they currently function as quiet, underused monuments to overbuilding. Celina represents a broader structural shift in outer ring suburbs, where the physical race to build has far outrun the financial capacity of buyers to move in. Number 5. New Braunfels shifts the focus from physically empty streets to the harsh economic reality facing families who migrated for a cheaper life. Situated between San Antonio and Austin, this historic destination became a massive magnet for buyers fleeing high-cost metros, drawn by the promise of affordable riverfront living and lower municipal taxes. But that dream has met a steep financial correction. As statewide median home prices dipped 15% from their peak, early buyers face substantial paper losses. More than that, the day-to-day cost of staying in these homes has climbed dramatically. Property taxes and rising homeowner insurance premiums are compounding the pressure of higher mortgage payments, making long-term budgeting a tightrope walk for working families. Sellers who once expected instant bidding wars now watch their listings sit on the market for an average of 40 days before finding a buyer. This sharp slowdown is weakening local confidence in uninterrupted appreciation, turning what was once advertised as an easy suburban escape into a high-cost holding pattern. While outer ring developments like Celina grapple with literal vacancy, New Braunfels represents a larger systemic issue across Texas. The question here is no longer when the next phase of construction will finish, but whether the families already living in these neighborhoods can actually afford to stay. As carrying costs continue to climb, the math of suburban life is being rewritten. Number 4. Forney once represented the promise of the North Texas housing boom, attracting thousands of families with cheap land and the dream of affordable homeownership. During the peak migration years, buyers rushed to this eastern suburb of Dallas, pushing home sales into overdrive and creating a market where houses sold in mere hours. Today, that rapid-fire rhythm is gone, replaced by a market where homes sit on the market for weeks. With local active listings climbing and average days on market creeping upward toward 45 days, sellers are finding that price cuts are no longer optional. The power has shifted entirely away from homeowners. In the entry-level starter home segment, builders are forced to pivot, offering heavy concessions and rate buydowns just to move properties that once sold themselves. This change hits first-time buyers and young homeowners the hardest. Many of them stretch their budgets to buy at the top of the market, wagering that the long, grueling daily commute to Dallas was a fair trade-off for guaranteed equity growth. Now, with prices flattening and inventory building up, that math no longer works. Commuters are realizing that the distance versus affordability trade-off has soured, leaving them stuck with high mortgage payments in neighborhoods where the streets are growing quieter and homes are lingering. In Forney, the fast turnover era has officially stalled, signaling an oversupply problem that is beginning to paralyze the outer rings of the Metroplex, turning yesterday's guaranteed investment into today's heavy financial burden. Coming to the top three, Georgetown is experiencing a shift where the danger is no longer just a slow sale, but the sheer cost of holding on. For years, this historic area north of Austin was marketed as a safe, picturesque haven for retirees looking to downsize and families trading up to larger properties. Buyers rushed in during the peak years, expecting stable equity in quiet neighborhoods. Today, those same buyers are finding themselves squeezed by a brutal combination of rising property taxes and soaring homeowners' insurance premiums. In Williamson County, these carrying costs are climbing fast, turning what seemed like a predictable monthly mortgage payment into an unpredictable financial strain. For retirees living on fixed incomes, these escalating annual bills are devastating, as their monthly budgets cannot absorb hundreds of dollars in extra carrying costs. Compounding this pressure is a heavy regional oversupply of new developments. With inventory piling up across the Austin Metroplex, existing homeowners who need to exit the market are seeing their resale confidence completely evaporate. Homes are lingering on the market for months, forcing sellers to choose between taking heavy losses on price cuts or paying thousands of dollars in carrying costs just to maintain an empty property. The cheerful optimism of the migration boom has dissolved into a stark lesson in fiscal discipline. This suburb has shown how rapidly rising holding costs can transform a dream retirement home into an expensive liability, paving the way for the absolute worst hit markets in the state. In second place, Melissa serves as a stark example of what happens when rapid, outer ring expansion collides with sudden buyer fatigue. During the height of the housing boom, developers rushed to this northern community, carving out massive subdivisions like Riverstone at Melissa and Lakewood Estates. They priced new construction homes between $425,000 and $460,000, banking on a continuous wave of buyers willing to commute to Dallas. Today, that frantic optimism has met a harsh financial reality. Instead of the rapid sales of the boom years, local inventory has climbed to a 3-month supply, transforming a once frenzied seller's market into a protracted battle for buyer attention. Homes that previously sold in days now routinely sit on the market for over a month. To prevent these brand new neighborhoods from stalling completely, home builders are resorting to defensive financial tactics. They are offering heavy price cuts and aggressive buyer concessions, including $10,000 closing cost credits and expensive mortgage rate buydowns to shield buyers from high interest rates. This heavy reliance on builder incentives reveals that underlying demand is far weaker than developers planned. For families and investors who purchased at the peak of the market, this widespread discounting presents a direct threat to their equity, as brand new properties sell for less than what early adopters paid. This mismatch between ambitious community growth and the actual number of qualified buyers creates a lingering inventory pressure that cannot easily correct. Unlike markets experiencing a temporary pause, Melissa is locked in a structural struggle to absorb excess housing, exposing the heightened financial risks of overbuilding on the suburban fringe. As developers scramble to find buyers for these half-finished blocks, the strain of overexpansion transitions from developer balance sheets into the physical reality of the neighborhoods themselves. And finally, in first place, Bastrop County's Colony Corridor represents the most severe market correction in the entire state. Once pitched as the crowning achievement of the Austin area migration boom, this sprawling corridor has become a quiet, half-finished monument to overexpansion. Here, the warning signs are not just statistical. They are physical, financial, and highly visible. Throughout these massive master plan developments, developers are grappling with staggering unsold lot ratios ranging from 25 to 40%. Walking through these neighborhoods reveals an eerie stillness. Entire blocks of completed homes sit empty. Roads are clear of parked cars, and planned phases remain graded dirt fields with no construction crews in sight. This combination of low occupancy, ballooning inventory, and stalled growth tells a much harsher story than price cuts alone. To keep these empty streets from completely freezing, builders are offering unprecedented concessions, from permanent mortgage rate buydowns to massive closing cost credits. This aggressive discounting directly threatens the equity of recent buyers, retirees, and investors who bought at the absolute peak, leaving them isolated in developments that look more like movie sets than thriving communities. The reality of the Colony Corridor proves that effortless suburban growth is no longer a guarantee in the Lone Star State. This is not a statewide collapse, but a profound recalibration of the Texas dream, a reality check where the pace of building has far outrun the financial capacity of actual families to move in. Across all 10 suburbs, one truth emerges. Unchecked supply has finally collided with economic reality. This isn't a statewide collapse, but a critical correction where rapid development outpaced actual demand. Today, rising taxes and high interest rates are forcing a massive housing reality check. Cheap suburban dreams often hide the steepest costs. Which Texas suburb surprised you the most? Let us know in the comments.